Good morning or afternoon if you're on the East Coast. Thank you for joining us today for Behind the Numbers. I'm Ashley Neville, Director of Insights at Carta. And I have with me today Mercedes Bent, who is a partner at Lightspeed. So Mercedes, you want to tell us a little bit about yourself?
Thanks for having me on, Ashley. It's always great to speak with Carta, which we at Lightspeed are investors in and have always enjoyed working with. And my background, I am a venture partner at Lightspeed now. I'm starting in the midst of starting a new firm as well. And my background prior to this, I worked in the operating at several startups, uh, led large teams, helped grow P&Ls 2 million to 100 million in revenue, and also was in finance before that. And I love investing at the intersection of consumer, app layer, fintech, and all of that. I grew up in an entrepreneurial and family in Silicon Valley. And so to me, like, this is just, I love working in this sector. I feel right at home every day.
Awesome. And you study behavioral economics, right?
This is right. Yeah, I started out comp sci major in undergrad when I was at Harvard, and then I switched to econ because I was there during the great financial crisis.
Mhm.
And I just thought it was super fascinating how everybody was losing, the homes around us. And I just wanted to understand, how did we get into these predicaments that everyone found themselves in?
Mhm.
And so rational kind of classical economics was not making sense to me. I said, this is not explaining the world around me that I'm seeing. And I almost dropped econ as well. I was like, great, I'm going to have to go find a third major. But then I found behavioral economics, and I was like, this is perfect. This describes the irrationality of the
Mhm.
markets that is actually unfolding before me. And so
Yeah.
I ended up working at the DC Fed and the Boston Fed on crisis related work with some of my Harvard professors. So I got to work on kind of post crisis cleanup work in '09.
Oh, that sounds fascinating. I also studied economics around the 0809 financial crisis. I like to
Okay.
the year of no jobs because I graduated right then. But like you, I have sort of this economics focus to my work. I think that's one of the things I love about data, right? Is data gives you a little bit of insight into the behavior at an individual level that often gets missed when you aggregate data up into really large numbers. There is always more stories there in the data than maybe the top line number is telling you. I think that's one of the things I love about data. So maybe to start, we'll start with some data. Um, so I found some interesting data yesterday about a third of employees, 1 in 10 workplaces, and 6% of workers. And it turns out that more than 1/3 of employees are self-professed Swifties, and 1 in 10 workplaces have a Swifties channel, and over 6% of workers plan to take today off entirely. This money or numbers are from Fortune. And so if you're joining us today or you're at home still in bed trying to recover from your 3 lessons last night, thank you for joining us. If you haven't been following the news yet, Taylor Swift dropped a new album last night. So I think it's going to be a slow work day for a lot of people
So we,
today.
so we know if Ashley has any stumbles, it's because she was up all night
I
listening.
did listen to it maybe 3 times through, but it's only an hour long, so that's not too bad.
Okay.
And they dropped at 9 here on the West Coast. So.
Assessment, good, like great.
Good. It's definitely a departure from her last album.
Okay.
It's like much more cheerful and upbeat. Maybe a little like too sappy love for me, but I liked the dark twistedness of the last album. But as I've learned with Taylor Swift, she really grows on you.
All
So
right.
an album that you're first like becomes a favorite later on. So
One of the things I love about Taylor Swift, which I'm not a huge Swiftie by any means, but I love studying greatness in all its
mhm,
forms. As we think about, obviously, as VCs, we're always studying greatness and founders.
mhm,
And she has definitely found a very formulaic way to
mhm.
constantly kind of repeat uh, kind of greatness and so I'm excited. I actually studied the last few albums of, like, what is it about her music that what does she repeat?
Mhm.
And I'm excited to give a listen and see if she's done it again. She has a very specific way she does her intros and hooks that she repeats over and over and over for the last 20 years. So I'm excited to see if that continued.
Yeah, agreed. I think that if Taylor Nation, her company, had been a startup we could invest in, a lot of us would have made some pretty good returns. But I'm with you on that. She's a very adept businesswoman, and very, I don't know, very nice to see her success. It's definitely from a lot of work on her behalf. So again, thank you for joining us this morning. Our conversation today is going to dive deep into the Carta State of Private Markets report that came out here about a month ago. And Mercedes and I had a really great conversation when that launched on our webinar that was breaking down the report. And she was like, hey, it would be really great if we dug deeper into this data. Like, what do metrics mean? So we're going to go through that today. Before we do, our legal team makes us pause for station identification and put out this exciting legal disclaimer that nothing that we talk about today should be construed as legal, financial, or tax advice. It's for informational purposes only. And now that it's done, what data are we talking about? We're talking about the Carta Data Desk data. And this takes multiple forms. Obviously, we're going to focus on the state of private markets here, but we'll talk a little bit about the other main reports that our team puts out. We are a strong and mighty team of 3 at Carta, and we have a really sort of unique focus on data. We don't charge for data. Data is not our business model. We literally do it to help the market be better informed in the decisions that they're making. And we find that a lot of people find a lot of value in our reports. Our reports tend to come out quarterly, and occasionally we'll drop an extra report like this consumer report, which I know is a topic near and dear to you, Mercedes. Our next report coming up is on SaaS. So what we're going to talk about today, we're going to dig into the report. We're going to talk about the data methodology behind the report. We're going to talk about how we define metrics. We're going to talk about how we do categories and classifications. And then what I think is the fun part, so make sure you stay, is interpreting the data. Mercedes is going to walk us through how she reads the various charts that come out in our report and how she tells a story by stringing through several charts together. So what is this data? Well, as part of the user license agreement with Carta's customers, our team has access to an anonymized version of the data that gets put into the platform. This includes more than 65,000 startups. It includes more than 2.5 million equity holders. A lot of those are employees at startups. We have companies in about 160 countries. Typically, we report more on US numbers, but we do have some reports on Europe, LATAM, and Asia as well. And then on the fund side, we have more than 9,000 funds represented. And very, very excitingly, Carta announced an acquisition this week of Excelix. It is a platform for LPs, and it's going to be bringing on 13,000 more funds and their data to our report. So keep an eye out for LP focused reports in the future. I think last bit is about 50% of all startups and 80% of all US unicorns use Carta for their cap table. And that means their data is included in all of our reports. Before we move on, Mercedes, do you have any questions?
Yeah, one thing I always like when one of the questions I had with this is like, because a lot of times I wonder with Carta data, okay, how representative is it of the entire ecosystem? It's super helpful to see on the unicorn side that we're looking at, the vast majority of the unicorns. And I guess on the earlier stage, side of the house, it's because I don't actually know how many VC-backed companies exist in total. Obviously, we see stats all the time, like there's 33 million like small businesses, but the vast majority of those are not VC-backed companies. So that's a question I kind of have when I look at this on the left is like, what percentage of the early stage market is it representative of? I think last time we talked about this, there was like a rough heuristic that it's like around 50%, I think
Yeah.
was my memory.
You know, we can't release the secret sauce exactly, but I will say that our data set actually tends a little bit more towards younger companies and younger startups. And the reason for that is our Carta launch product, which is a version of our cap table that we make available to all startups for free until they raise their first $1 million. And so we have access to all of their pre-seed data. And so we can go all the way back in time and understand the entire picture of their investments over time. So we're not waiting for a seed round or a Series A round until we're getting that data. We're really often starting very early on when companies are raising their first safes or their first pre-seed instruments. That data is coming into our data pipelines for market trends. And then because we have only in the last year or two really moved into supporting companies with IPOs, we tend to sort of, as companies are 6 to 12 months out from an IPO, we tend to get less visibility into their data. We do have a really great partnership that we launched this year with Morgan Stanley to help Carta customers through the IPO process. And so we're really hopeful that more of those companies will stay on the platform and will continue to be able to see their data.
Great.
Just quick, give you an idea of some of the companies and VC firms and their portcos that are on our platform. Just give a little feeling. And then in terms of venture funds, we have 2,700 venture funds that we include in our fund report. Just came out again in September. And this breaks it down by fund size, and this breaks it down by vintage year. So you can see, obviously, there were a lot of 2021 and 2022 founded funds. And our data set is really strong in the sub $100 million fund area.
And question on this would be like multiple funds with the same firm could be included, right?
Yep. So this is analyzing like if a firm has multiple funds, or say they're raising, you have one GC raising multiple funds. Those are each a separate fund in our system.
Yep. This is great. And I think, today the deployment cycle on average, I think, is closer to 2 to 3 years, but there was a period in 2021 timeframe where the deployment cycle was like 18 months for some firms.
Yep.
And so, it could represent a lot of different firms or not as many, depending on just people's deployment cycle.
And interestingly, what we tend to see is that if a fund is maybe coming to Carta for fund administration, they might leave some of their older vintage funds on their previous platform. And then the new fund that they're establishing will be on the Carta platform. So, and sometimes it's like a big lift that they move all of their funds over, but sometimes we're just getting their latest funds that are just launching. And then in terms of startups, we have over 40,000 priced rounds. These represent 65,000 companies. So we still have, if you do the math on there, we have about 25,000 companies that are still in the pre-seed stage. And so again, the sort of that distribution a little bit to the younger company as it's being founded. But obviously, as we start talking about graduation rates and other things later, we can see that there are less companies that are making it to the later stages. And so that's another reason why we sort of have these sort of younger funds represented. Now, if a startup closes, we still have the data from their earlier rounds. And we do include that data. So let's say a startup was founded in 2021. They sort of struggled to raise capital. They are acquired. There's, they end up closing. Another way of sort of moving the company forward, their historical data stays in our data set. And And then at the 7-year mark, we no longer retain row level data at the company level once they leave. So 7 years after they depart. So our metrics start locking historically at the 7-year point. We stop changing those or updating those metrics. Because we're adding new companies onto the cap table platform, oftentimes maybe later when they're raising a Series A or a Series B, and we're importing all of their historical cap table data, we do see fluctuations in our metrics over time. So if you're comparing, say, the Q2 report to the Q1 report, you might see in the Q2 report that the Q1 number is different. And that's because either they took 6 months to add the data into the cap table, which happens. Oftentimes it's like sitting as a pile of papers that needs to be inputted in, but also because as we bring new companies onto the platform, all of their historical data is going back. So the last 7 years of data gets updated regularly. And that's one of the reasons why you often see us cutting off our data at, to start at 2018 or 2019 in our reports.
Oh, interesting.
Yeah.
Okay. I had wondered that. I was like, is it they don't have the data past then, or that's just when the product launched?
Yeah. And so if we save data in an aggregated form, because we want to make sure that no customer is able to be re-identified directly from the data set. So we can't save that older data at the row level. And so as we're doing net new analysis, maybe we didn't define that metric before we had to aggregate the data. So we no longer have access to the older data if we're adding a metric to the report that maybe we haven't included previously. And so often that's why the cutoff is there forward.
Yep. And this chart above, by the way, is interesting. We can maybe come back to it in our data interpretation section.
Yeah. I think it's also interesting too, the sort of breakdown between primary and bridge. Obviously, a lot of bridge rounds being represented here. We're seeing on a quarterly basis between 14 and 18% right now. So very interesting.
And how do you guys define bridge?
So when so we take the stage is actually a field that a customer inputs when they're adding round information or investment information into the cap table. And when the customer, say, takes, they take an investment, say, from Lightspeed, and it's going to be added on the cap table, the customer actually denotes which stage it's in. And so they will actually tell us if it's a seed or a Series A. They will tell us that, and we use that as sort of the baseline. And we do a little bit of follow-up and double checking to make sure they didn't accidentally input a stage C when they're still a seed company, for example. And then for bridge rounds, we have a 6-month buffer after it looks like the primary round closed. If there's no activity for 6 months, then we start calling it a bridge round. So typically what we see is that investments for a round come in sort of giant waves.
Yeah.
And so either they're telling us it's a bridge round, or sort of we're looking at it if the valuation's different. If they're telling us it's, they're Series A still, but the valuation's different, that's sort of another mark for us that it was a bridge round and not part of primary.
Okay. Interesting. So they might not actually type in bridge, and you might still classify it as a bridge. Okay.
Yeah. And we have a really great data science team behind our team of 3 in the insights team that is doing a lot of this processing and cleaning up of the data on the back end.
So like a series like a Series A1 or a Series C1 or a C2, those would all be counted as bridges?
Yep.
Okay, interesting.
And typically we don't, in our price round data, include AA rounds or preferred rounds. Typically we remove those from the metrics.
Okay.
So let's talk about metrics. So if you're curious about where different topic metrics fit in our reports. This is sort of a nice breakdown. So SOPM is our shorthand for state of private markets. And that includes cash raised, round volume, valuations, dilutions, down round, bridge rounds, and graduation rates. So that all lives in our state of pre-market report. And then in our pre-seed report, we do a breakdown on safes, convertible notes, check sizes for pre-seed companies, valuation caps, preferences, and we have some graduation rate data. And then our fund report, which we are now releasing quarterly, gives us data on dry powder, check size, number of LPs per fund, and then the data that all the funds love, TVPI, DPI, and IRR. And it's been really fun that we've been able to release that quarterly. Last year, or historically, we've only released it annually. So we're getting much faster updates on that data now, which is exciting. Are there any topics in here that you think are missing that we should be covering?
It's somewhat tough in terms of I think a lot of the data that I would say is additional is probably data that maybe the Carta platform wouldn't quite have. Like I always think through to what are the benchmarks for revenue and profits and things like that. But I don't think you have access to that. I guess like I think this covers most of it. The main other area I'm interested in is secondaries. And to me, that is just an area of venture that is growing rapidly. If you think about how a lot of the larger VC firms became RIAs in the last few years, which lifts the 20% exemption on, it lifts the VC exemption status, which removes the kind of 20% threshold of things that are not the typical VC assets. And so basically bigger VC firms are purchasing more secondaries. And I think, when I look at primary versus bridge, I actually think the primary versus secondary is more often how I think about the juxtaposition of what type of funding a round is. And primary being like I bought equity directly from the cap table. Secondary being I bought equity from somebody else who had access to the direct cap table. And so that's just an increasingly large part of venture that is solving for liquidity. It's solving for founders not wanting as much dilution. And we don't yet have a very standard, secondaries market platform where it's easy to you still have to do a lot of hand-to-hand relationship building to access it. But I don't know if you guys can tell which ones are secondaries, but yeah, that would be super.
It takes a lot more effort on our report on our side because it's not like reported directly. But we do put out a report once a year on tender offers and secondaries. I like your thinking, though, that instead of showing valuations by bridge and primary, that it would actually be more interesting to sort of group those together. We call them combined fundraising type. That's how we talk about it here, against secondaries. I think that would be actually a very interesting chart to look at. So I'm going to note that for the Q3 report. See if we can do it. Challenge ourselves.
Nice.
Okay.
No.
Anything else here?
No, that was the main one that came to mind.
All right. So then, unless otherwise stated in our reports, these are the 4 filters we always apply on top of our data. So we're looking at companies registered in the US. We're looking at figures in US dollars. Our legal entity type is always corporation. And then, meaning that they've had to incorporate somewhere. And then we exclude, as I mentioned before, the non-standard rounds from the data. And then I guess before we go on, maybe I'll talk about like a crazy amount, like 92% of companies on the Carta platform are registered in Delaware. And so we don't use registration location. We actually use the address on their billing invoice as their headquarters location. So that's how we're setting, if a company is billing, maybe they are an international company, but they're billing to an office in the US, they would be included in the data.
Okay.
So then what metrics do we look at? So generally speaking, our philosophy is to look at medians, totals, counts, percentiles, and percentages. We try to stay away from counts directly and look more at percentages because they're better to look at over time than a strict hard number. We really like medians. Medians are more accurate than averages. So it's actually very rare that you'll see an average on our report. And then you had some questions for me about our metrics. So maybe we can sort of jump into how we define some of these things. Are there any that come to mind?
Graduation rate was one that stuck out to me because in the VC industry, this is one that is used to measure the success of a VC,
Mm-hmm.
is which percentage of your companies graduated from this round to the next round. And so I'm curious how you, and of course we use your data as benchmarks for whether or not we
Mm-hmm.
were good or not in the graduation rate. I'm curious how you defined graduation rate.
Well, let's go ahead and put this chart up and sort of dig into it directly. I think it's good to have it sort of up as we're looking at it. So we report graduation rates as movement from one stage to the next stage. So if a company is, say, they're raising Series A and then they're raising a bridge, we haven't considered that they've graduated to Series B yet. They really have to raise at the next level. So when we're looking at graduation rates, we're looking at two things. The first is the year that or the quarter that they first took fundraising at, in this case, seed. And then we're counting the number of quarters until their fundraising at Series A, their first fundraising happens at Series A. So that seed date is on the vertical left column, and then across the top is that time elapsed since the date on the right.
And that would be when they input the data themselves into the system, saying like, hey, here's our Series A document.
Yeah, so there's actually a field that allows them to put the raise date in. So it's not the date that it was added, it's the date that they say the agreement closed.
Yeah, okay. Okay, so the date that the agreement closed.
Yeah. And then what we're doing here is we're dividing the top would be the number of companies that are in this cohort divided by the number of companies in the left column is how we get our percentage. So it's number of companies that have raised at Series A at this point from the date divided by the number that were in that cohort.
Yep. Great. And yeah, like companies dying and stuff is like, they're still obviously included in the denominator because they were there initially. So this isn't like a survivorship bias or anything. Yeah.
And so I think sort of what's interesting is when we color this, so we don't focus on the numbers specifically, but sort of the ballpark range of the number. And we do that through this sort of picking the background color. We have these at the end of 4 years, if you look back at these like 2019 numbers, we had like graduations rates up into the 50%. And to achieve that at the end of 2 years, those rates were around 30%. And you compare that to companies, say, that raised funds in Q4 of 2022. Now, 10% of all fundraising happens in December alone. So I think Q4 is always a really good quarter to look at. And so if we compare sort of this number here in the 15 to 16% range, it's half of what it was just 4 years before. And I think that delta and that differential is the interesting story rather than the graduation rate is 16%.
No, for sure. With all cohorts, it's always the shape of the curve, where does it flatline, and what are the trends and how the cohorts have been performing. And I think, I mean, this data paired with a bunch of the other charts that you have think just show, obviously we're in a scenario where more and more companies are still alive, but not raising and not kind of converting to that next round. And I have a lot of hypotheses and theses on why, but we can come back to that too.
Okay, we'll come back to it because this slide is in the deck later again. We good on graduation rates, or we want to talk about another metric?
I think I let me see, what was the other ones on that slide? If we can go back to that slide.
Oh, yeah, hold on.
I think it. Oh yeah. The step multiples, what is that one?
Step multiples would be the valuation change between primary rounds.
I see. Okay. So kind of, and that's measured off of pre-money to pre-money.
Exactly.
Okay. Cool. Yeah, no, most of these are pretty straightforward otherwise, I think.
Yeah.
Yeah.
All right. Let's see, go here. So categories and classifications. Industries is always one we get a lot. Questions about sort of what is included where. So we use 14, what I call industry levels. And you can see that 34% of all startups on the Carta platform are in the SaaS industry, for example. And we sort these industries into digital, physical, or other. So you can see that by the coloring, black being digital, orange being physical. And then other oftentimes is sometimes it's not filled out as often as it's just like not in the categories. It's just like we don't know what it is.
Yep.
But sometimes you can have sort of interesting outliers and stuff that fall into that bucket. So we always like to include it.
And these are the way you get at these classifications is via the stuff I think you have on the next slide.
Yeah.
It's self-reporting or more your analysis of what the company's business is.
So we do it one of two ways. So in our State of Private Markets report directly, we are currently using the classifications that the customer sets for their company or their account manager sets on their behalf in the product. And so they're picking from a drop-down list, and these are all of the options in that list. Now, it's not fully inclusive. I think there are definitely probably some that are missing from here, but overall, this is sort of how we categorize what I call sectors, the non-bolded, capitalized text here, into industries. Now, we've sort of been limited by this the last couple of years, but we've recently gone down two different paths to improve the data quality around industry classification. So the first way we've been doing that is through partnerships. So if you're not familiar, Net Zero Insights is an organization based out of Portugal, and they maintain a taxonomy of companies in the clean energy and industrial innovation space. And that taxonomy has 14 different levels to it. So they get if ours is 3, they get really deep. And so we did a partnership with them, and they provided their taxonomy to us along with identifying information for corporations. And we built a cohort that was an overlap of all of the companies in their list and all of the companies in our list. So think Venn diagram, everything in the middle. And we provided that data for them to be used in their report. But as part of our agreement with them, we now have this classification of these companies that we can use ourselves in our reporting. So that's the first way that we're going about it. And then the second way about it is we enrich the data using a product called harmonic.ai. And we've had a lot of success with the product. It's a great startup. So if you're looking for investment opportunities, we've found it a delight to use. And we're actually using them to categorize AI versus non-AI companies. Now, we don't say AI native, We just say AI companies because AI native to us means a company that was non-AI that pivoted to AI would not be included in AI native.
Do you know how they're defining what's AI versus not?
They maintain a list themselves.
Okay.
Hamza on our team is the analyst. He's actually the one who did this project on AI. So he knows the nitty-gritty details. I just trust Hamza.
Awesome. Yeah. It's so interesting. I think with like a lot of these companies, the question of what falls into what, and so much of the labeling, I think, is sometimes on the categories like a consumer versus, SaaS is somewhat obfuscated. Like, is which one is OpenAI, and like, for example, Zillow, if I look at public markets like Zillow, DoorDash, Fiverr, NerdWallet, Roblox, they're all listed in communication services. And versus like Lyft, Bumble, Duolingo are included in technology, whereas like Tesla, Etsy, Airbnb are listed in consumer cyclical. And this data was from a report that Forerunner put together. And so, those companies are all companies that could be considered consumer companies in one way or another, but they're listed in 3 different categories. So I always wonder, like, when we look at the sectors and classifications, if we can really glean very much from it, because I think there's a lot of obfuscation in just the categories there. This is probably more straightforward because it's a bit more binary, the AI versus non-AI. But the categories I have a hard time reading into.
Let me ask your thoughts on something then. Is in our metrics where we're, say, breaking out by industry, do you think a company should be included twice if they're in the relevant industry, or should it be binary, one-to-one relationship between sector and company?
It's a great question. I think for the simplicity of understanding data, binary is better in terms of people, doing percentages and counts and everything. But at the same time, for the accuracy of data, realistically, I mean, most large companies are, and especially the winners, the top things, they're all both. I mean, Amazon is consumer and enterprise. They have AWS and they have their marketplace. And, same for Google. They have their direct to consumer monetization, but they're also a huge B2B advertising business. And so I really tend to think the best are both. And I would almost, like, if I were doing a really bottoms up first principles analysis, I would classify them based on the percentage of their revenue. But then it's like, well, how would you maintain that? Would you be keeping a ledger of their revenue and splits and then maintaining it between the categories? But really, that's what should be done.
Yeah. Interestingly enough, before joining Carta, I was the data evangelist at Tableau. And one of the really interesting things is we did this internal project for our CEO. And we looked at sort of, this is more public market space, not private market space, but our taxonomy there from parent company to lowest company went 14 deep. So even in the public market world, you have a company that maybe is playing in consumer and enterprise, but then the parent company is holding across a wide portfolio of companies, right? So then how do you classify that top company, right? So smaller problem in the startup space because the companies just haven't been around as long and haven't had time to evolve. But I do think that this is definitely a space to think about. One of the ways that I'm thinking about it is just like AI, it's an overlay on top across industry. And I actually think we should be creating more of these overlays. I think for a long time we looked at tech, right? Like health tech, ad tech, education tech. Tech is an overlay. It's not an industry. And I think that might be a better way to start thinking about it, is like, what are these overlays that we want to call out rather than sorting companies into, and then it's a binary, you're in the overlay or you're not, but you can be in multiple overlays.
Yeah, I'm totally with you. I think there should be some there should be different phrases or words or key terms for different combinations of overlays as well. It's an interesting
You and
idea.
I should sit down and brainstorm some of these.
I know a lot of people are searching for what term we should be using to describe companies that have more of this category fluidity, because at the end of the day, labels make things simple, but they oversimplify, and then they end up creating problems from their oversimplification.
Right. Exactly. I think this sort of goes back to what I think will turn into the theme of this talk is looking at the forest for the trees.
Yeah.
And, sometimes we get hyper fixated versus sort of stepping back and looking at that bigger trend, the bigger pattern that's happening, versus like when we get too overly focused on classifying a company, we tend to have to break down to the number of categories to a level that's sort of unattainable. And then it starts challenging our sample size minimums. And so that keeping it broader and sort of saying, okay, more holistically, what is happening, I think is a lot more interesting and helpful. I think we sort of want to laser focus in, but like, one that was missing. I got a question about space the other day, space companies. And we break out satellites, but we don't break out rockets. So can you have satellites without rockets? That's a really good question. So that was one that sort of had me stumped and was like, oh, I really need to dig into the data. And some of the ways that we do that is we like look at the company, a sample of companies that we know categorically fall where we want, and then we look and see how they're classified in our system.
Yeah, super interesting.
Okay, so and then we talked about headquarters location earlier. 50% of all cash raised goes to startups with a headquarter address in California.
These ones in gray, is this meant to say that there was no capital raised in any of the states?
It's not that there was no capital raised. It means that there was less than 10 companies on the Carta platform that raised in that state during that period. So again, we don't want to be able to allow someone to work backwards to find out proprietary information about a customer and their data. So again, we have to gray it out if there is insufficient data points.
Okay. Yeah. Interesting.
But we do. So if you sat there and you added up all of the totals in the state, you would find across the states for a region, you would find out there's a gap, because we do report those states as part of their region. We just don't break them out by state when the number is too low.
I see. Okay.
So
wow, that's a lot of states at zero.
You could work backwards, to, like say in the Northeast. So Northeast was 22.6%. You could subtract everything in the states and then say like Vermont, Maine, Rhode Island, and Delaware equal X.
Right.
Someone could get like very creative, and then they could like multiply that against the numbers that are in the quarterly. They could add up the quarterly numbers at the start of the report and like back into it if they like really wanted to do the work, but we're just not going to do the work for them. All right. So the fun part, we have about 13 minutes left. I think you have a hard stop at 10:30. So hang with us for another 10 minutes. Mercedes is going to go through these charts and sort of narrate out loud what goes through her mind when she looks at them. And they're roughly in order from our State of Private Market reports. So we always start with cash raised per year to date. And we include this dotted line to help you realize that that number is probably going to go up. Actually, it's very likely it will go up. But you can sort of compare year to date on the quarterly basis on the bottom by count of.
Yeah, and I look at this chart and I continue to think, okay, fundraising amounts have been roughly flat for the past 2 years or so, ever since the downturn began in 2022 when interest rates rose, and that we're about level, to where we were pre kind of 2021 bubble cycle. And so that kind of always checks out to me as like, okay, we're continue to be somewhat on pace in terms of total cash, but the composition of cash, as your other slides show, is where the story is.
Yeah. Then I think this helps this is breaking down that same data by quarter. And I think it very much illustrates just how steady the market has been the last 10 quarters or so. In fact, in Q1 of this year, the 8-quarter moving average was exactly almost to the dollar, the same as the amount raised that quarter, which I just found so fascinating. It's like, it's just like such a sign that it's just like steadily performing quarter over quarter.
Deployment, and rounds are still happening. I think this data might be surprising for people who think and feel like in 2025 there's been way more funding announcements, much bigger rounds. But when you really look at the data in aggregate, it's not 2025 is not a departure. And so, people have been asking the question, are we in a bubble in 2025? There are other signs that would point to that or not, but the total deployment of dollars has not gone gangbusters as it did in 2021.
Exactly. There's plenty of capital to be had out there. I think one of the trends that the rest of the report supports is that funds are more picky about the deployment of capital and who they're giving it to. And I think we're seeing more big bets across a smaller number of companies.
Yes.
Even though the same amount of capital is being deployed. So then the anecdotal experience is that you're hearing these big numbers, but at the end of the day, the pot size is staying the same.
Yeah. But then that also means less people are getting, the funding. So that's a real impact as well.
Yep. And our reports do break this out by stage, and they show the cast rate and the count of rounds. So if you actually look at the seed, for example, in the Q2 report on this slide, but just for seed, one of the interesting things you'll see is that like the count of rounds stayed the same, but then total cash raise took this like giant step up. So same number of companies, but companies getting more dollars.
Yeah.
All right. The other ones we've been breaking out is terms.
And this is terms in the term sheet in terms of talking about a multiplier that people want on liquidation preference, or how is this showing up?
Yeah, so this is off of the term sheet itself. Because we're so zoomed in on these, it looks like there's a lot of variation. But if you look at the axes on the left, what you see is that it really just goes to 10%. And so there's a very small range of a couple of percents that these change by. And so on one hand, you could say like, okay, we're seeing multipliers show up now more than it did 6 years ago on the term sheet, but it's not that much more. Yeah. And I actually think that that's the read of this chart. Also, I think the other read is back in 2023, we sort of saw this influx of multiple terms on the term sheet. And that has been decreasing just a little. And to me, this is a read of, is it a more investor-friendly market or a founder-friendly market?
Yeah. And I was going to say specifically, I mean, multiplier is usually used in terms of a liquidation preference multiplier, which the way to interpret this would be that VCs are asking for more, it's a little bit more onerous of a term, saying like, I went on liquidation, I should get a greater preference versus my 1x if it's 2x or whatnot. And so that does show a bit more conservatism in how VCs are pricing what they think the exit will be of rounds. Essentially, they're trying to construct greater liquidity for themselves and saying, I don't know exactly how this thing is going to turn out, so my capital needs to be giving me preference to return more.
Interesting. Would it be more interesting to you then if we showed distribution across the term? So like for a multiplier, for example, 1x, 2x, and the various distributions across multiplier, that to me, like based on what you're saying, would be much more interesting than this sort of binary, did they have it or did they not?
Yes, that would be much more interesting. The fact that it's showing up more at all is a signal that, this means when the company sells for, if you had raised 100 million and the company sells for whatever the company sells for, like 120 million, the liquidation preference, like that 100 million has to go. It's like it actually sells for less. Say the company sells for like 50 million. Well, the 100 million, that liquidation preference is like, that's your preference stack. That's what investors have to get back first.
Yeah.
And so in the case where you're selling for less than it, I mean, 100% of the proceeds are going to the investors right away. That would have happened anyway. But when the multiplier is above 1, then even if you had room above where you raised, that extra 20 million, the 100 to the 120 million, some of that could also be going to the investors.
And we've seen cases of founders who sell their company and pretty much walk away with no money because they didn't understand multipliers and liquidation preferences. And so they accept a number that sounds really big, and they're sort of like, okay, well, we raised this much money. But they're like failing to do that additional step. And then they're sort of at the end of the day, sort of left with very little for the amount of effort they put into the company.
I think something founders don't routinely realize is that the amount of capital you've raised is the value of the company, essentially, and that for any sale above that amount is always going back to the investors. And with any liquidation preference, it's that plus more. And so really there's when founders are celebrating, like, I raised 50 million, I'm like, okay, that means that you have to exit for well north of 50 million. Otherwise, like, who cares if the valuation was 300 million? Right now, your company's effective, like, clearing price valuation has to be that 50 million. Because when an acquirer comes, a lot of times all they do is say, well, what's the amount that the investors need to receive back? I'll give a tiny bit more than that.
Yeah. And we do a lot of talks with accelerators, helping them sort of understand the dynamics of the market. And this is definitely something that they don't understand. There's this sort of cachet around, I raised X amount of money. But the reality is they shouldn't be taking that money unless they can use it to exponentially scale the company. And so the focus shouldn't be on, I'm going out to raise a large amount of money. They should be thinking about, what is the amount that I need to raise to be effective in my scale?
Yep, totally.
All right. Bridge rounds, one of your favorite topics?
Yeah, bridge rounds. And I think there was another slide, the time between rounds, increasing. And these two slides together sort of paint a picture for me that we're really living through a tale of two markets for founders, especially with the other data that, round deployment of venture capital dollars is staying fairly consistent. If you put all three of those together, okay, the deployment cycle is consistent, but it's taking many founders much longer to raise, and people are raising, these small bridge rounds. Then what's happening is really that people are not graduating to the next phase. They're not commanding the conviction from investors that they've reached the next stage milestones. And so they're kind of breadcrumbing along the way more and more often to stay alive, which is lengthening out the time between rounds. So then, well, if the numbers are consistent of the deployment, where's all that extra funding going? It's not all going to, these bridge rounds. It's going to larger rounds for the people who did succeed in graduating to the next round. And so that is really, I think, what is interesting about what's happening now. Obviously, like you guys have said it many times, which is that, some people are raising, fewer companies are raising more dollars, and the rest of the market is kind of, if they're not dying, they're getting by with smaller bridge rounds. Now, is that good or bad for the ecosystem? That's a broader question, because before, companies used to raise, and if they didn't make it, they would die. And now companies are kind of hanging on for much longer than they did before. I think there's a question of, is that good for the downstream capital effects? That dollars could have been maybe recycled back to
Mhm.
the firms, which could have gone to other new companies that might have made it, or, like, is it good because, well, those folks that their company, it would have, died, they still are employed, but they're not often hiring a lot of people when you're in kind of going in a sideways position. So if anything, like, those employees are locked into companies where their value of their equity isn't growing rather than,
And I think that's very true. If you look at our compensation report, which is the sort of the fourth report of our stool, we see that companies are 10 to 20% smaller today than they were even 2 years ago. And on top of that, roughly, I think somewhere around only 30% of employees who are departing and have options expiring are executing those options. So you are seeing sort of this larger picture when you step out of just valuations of like, we're being small, we're being mighty, but the companies themselves actually aren't growing in value to a point that it really is worthwhile to make additional investment in by buying your ISOs.
Yeah, I think this is kind of the great startup stagnation post 2021 of lots of funding. We now have a stagnation era for a lot of
Yeah.
companies that we talk about it a lot with zombie unicorns. We need to talk about it more with the early
Mhm.
stage companies as well, and what should happen there. But anyway, this has been so
Yeah.
fun.
This has been
This is
great.
so nerdy to geek out on kind of the data and rationale
Yeah.
behind, but this was really fun for me. So
Awesome. Well, I enjoyed having you. I enjoyed talking. I actually learned a bit about how we can make our reports better. Thank you again for joining us, Mercedes, and maybe we can do another one of these again.
yeah, next time you
And
guys have a report coming out, let's do it.
yes. Okay. Love that idea. And if you're new to Carta Data, subscribe to our Data Minute newsletter. It comes out every Thursday or Friday. It's a 5-minute read, has one chart, one short analysis, but will really enrich your week. So just scan the QR code there if you want to be signed up. And Mercedes, thank you again. It was a pleasure chatting with you.
Thank you so much, Ashley. Happy Swifty Day. Bye.
Bye.